Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's webinar being brought to us by MarketLifeTrading and Talent Advisors. I'm very pleased to have Adam Grimes with us today to discuss trend dynamics, measuring and assessing trend strength with technical tools. So with that, please all join me in welcoming Adam to today's webinar. Adam, I'm going to go ahead and make you the presenter, so if you can share your screen with us, let's get underway here today. Thanks for joining us, Adam.
Thank you, Cynthia. Does the screen share work? Does my screen showing?
Looks perfect. We see
Fantastic.
it in full screen.
Beautiful, thank you. Okay, so Cynthia also asked me to begin with a short bio, and I will say that a lot of my information is already out there on the internet, so you certainly can Google me. I've written a few books. I'll share some snippets from the books later. I also have two websites, MarketLifeTrading.com and TalentAdvisors.com, which Market Life focuses a little bit more on education. Talent Advisors is more of an institutional portfolio advisory. We look at macro and technicals together. But I think the thing that makes my perspective a little bit different than many is I started down in the trenches as an individual trader, and I knew very little, just to be perfectly honest. I made a lot of mistakes, figured things out, educated myself along the way, got some formal education, and over the years I've traded pretty much every liquid asset class and every time frame from very short term to very, very long term. My perspective tends to be a very heavily quantitative perspective, but I am a discretionary trader, and that's going to be the context of today's presentation. Is we're going to look at using quantitative tools, but what do they tell us? How can we put all of these pieces together and begin to understand the big picture, which is what the trend is really about? And this is such an important topic. The idea of understanding how markets trend, how trends work, how trends break down. There's no holy grail in any type of trading and investing, but this is probably as close as we get. So, brief outline what we're going to do here. We're going to talk, first of all, what is a trend? How do we measure trend? We're going to look at some answers from traditional technical analysis. I'm going to talk about some good things and some bad things with these tools. We'll look at the trade-offs, and we'll wrap up with some practical trading guidelines. Through all of this, and also through much of my work, the focus is really going to be on limitations and blind spots, what we might not be seeing quite as clearly as we wish we could sometimes. So I guess I'll just throw this slide up here at the outset and say markets trend. And anybody beginning to look at price charts will see trends. What is a trend? You might have this very basic understanding that you kind of know it when you see it. And I think if we look at the screen here, you can see it kind of seems like the market doesn't really trend until about halfway through the chart, and then you can see my mouse there, and then the market goes into a pretty clear downtrend. That's actually an accurate definition, but we need to do a little bit better than that. And from a practical definition, here are some ways I would think about trends. What is a trend? Well, it's a market movement from one price level to another, like we saw on that previous slide. Here's a more quantitative way to think about it. It's a market movement where momentum, or in which momentum dominates mean reversion. And just a few words on that. I believe, and this is a little bit difficult to prove, but I believe that all market action is really shaped by the interaction of momentum and mean reversion. Mean reversion being the tendency for a market to go in one direction and then to snap back. It's the snap back mode. The rubber band stretches too far, you go outside of some band or something and snaps back. Momentum is the opposite. It's the tendency for a market to make a big move in one direction and then to continue to make other moves in that direction, in the same direction. Now, those are counterbalancing forces, but what we can do, and what we're going to do today, is to look at elements of how markets move, how markets shape themselves, to see if we can get some insight into where one of these forces is likely to win in the future, because that's what really matters. You know, we look at a chart, It's history, or at best, it tells us what's happening right now, but where we will have risk and opportunity is in the future. And obviously, if we're talking about a trend here, when we have a trend, mean reversion will lose to momentum. I'm not going to take this much time on every slide, but I think that that's kind of an important point. Another thing to think about is that trends are driven by an imbalance of buying and selling pressure. And one of the things, thinking about my understanding of markets as I began, as I said, knowing basically nothing, I assumed at the beginning, in a lot of things you read, suggests that there are these almost kind of magical forces that move markets, right? A lot of people talk about a lot of ratios and a lot of whether they're supposed to be watched institutionally or there's some almost mystical significance. As I did more and more research into how prices actually moved, I became convinced that none of those things were true. In fact, the only thing that moves markets is somebody, or in reality, it's somebodies. It's a group of people wanting to buy or sell a market more than the other side, and that moves a market to another price. When that happens, also we have a failure of liquidity. And we've gone through some points in recent years where we've talked a lot about liquidity in markets and HFTs. But if you had a market with perfect liquidity, one way to think about that might be that any order could be absorbed. So the market isn't going to go anywhere. There's people willing to buy and sell at this price. And for us to move a market to one side, we need a failure of liquidity on that side. We need, for instance, when there are tariffs announced and people get concerned about soybean prices, we need for people to want to sell soybeans more than people want to buy, and that will cause a trend, just a current example. Now, some caveats, some things to think about. You do need to be aware that random data trends. So there's a tendency to see every time a market trends and to say, oh, something must be going on. A trend alone is not evidence of there being something meaningful or significant in a market. And you can, you can do this yourself. If you have a lot of time, sit down with a coin and flip a coin, score 1 for a head, -1 for a tail, and graph that line that you would make. And you would find, even just randomly flipping a coin, if you've never done this or you've done it in a spreadsheet, obviously would be the way to do it. But you'll be amazed how long and how persistent some of the trends can be in random data. So it's always something to think about. Trends certainly can be seductive. And again, I'll go back to my early experience. I remember seeing price charts, looking at historic price charts, and just drooling over how much money I was going to make with all of these easy trends when markets move. And of course, when we actually start trading them, it's a little bit more difficult with that. Fortunately, there are patterns associated with trends. We're going to look at a lot of these, patterns associated with a trend beginning, a trend ending, and very critically, a trend continuing. We can, if we look at some of the subtleties of price action, we can begin to understand where the probabilities might tilt. And in fact, everything we're doing here only works within a range of probabilities. Before I switch directions here just a little bit and talk about technical analysis, I do want to say I'll do Q&A at the end of the presentation. My intent here is I'll stick around as long as you have questions. So if you have questions as we go along, go ahead and enter them in the box, but I probably will not address them until the end. I don't always multitask very well. So type your questions so you don't forget them. I promise I'll get to them at the end. Okay, so some answers from traditional technical analysis, ways that we can measure trends. Well, we can look at market structure, which is basically just looking at patterns and prices. We can look at moving averages, trend lines, and indicators. I'm guessing most of you listening to this presentation have run into a lot of these things, maybe all of these things. I want to refresh your memory on some of them, maybe show you some things in a little bit different direction. So the fundamental trend pattern from a price pattern perspective is this. You have a market that goes up, and I've labeled this, just look on the left here, A to B, and then you have some kind of pullback. And of course, if the market's going to trend in one direction, it can't pull back more than the with trend thrust. If it did, we would be going down. But this is the pattern that drives, that shows up in every trend on every time frame. And some people, again, have gotten kind of mystical with this, and they've talked about pulse and retracement and things like that. Maybe there's something there, but you don't really need that. Here on the right side, you see the same pattern in the downtrend. Just understand the basic pattern of trends is a with trend move, and then a little bit of a pause, and then another with trend move. Now, one of the interesting things is that when we drill down into time frames, you'll see that this works on lower time frames as well. And it does, you can go down to a 1 tick chart even, which in active markets can be incredibly fast. You can have very active markets can have thousands of ticks in a second, much more than you can process. But even on that level, you will find the data looks a little bit different, but it's very interesting to look at low-level tick charts, and you will still see the same thing we see on hourly, on daily, on weekly, on monthly, even on yearly charts. If you go graph the Dow Jones from the early 1900s, you'll see that this pattern is there on every time frame. Maybe it says something fundamental about how people deal with risk and opportunity in markets. So I said at the beginning, it's not really enough to just look at a chart and say, hey, that's trending. We need to define them a little bit better. And one of the problems is the same area can often be called a trend or range, or sometimes we can say we don't know. And if you're new to technical analysis, I would suggest that this uncertain category should be in your vocabulary. A lot of times, and a lot of books, I think, will give us a false sense of competence or security. I don't really know what the word is, but I'll tell you personally, when I look at a chart, there are very few times that I can say I have extremely high confidence about what this market is going to do. If you give me 20 charts to look at, I'll probably throw 17 of them back to you and say I have no edge. I don't know. And when you start to realize that you can understand price action in a way that leaves room for the uncertainty, which by the way is there, the uncertainty is there anyway. It's just your choice as a trader or analyst to embrace that noise. When you do that, it's really, truly liberating. So seems like a maybe not incredibly important thing, but understanding that markets can be uncertain is very, very important. And of course, depending what time frame we look at and what definition we use, we're going to get slightly different answers. And here I have just extended this very simple understanding of trend action with the price pulse, the move in the direction of the trend, retracement, and then you can see how if we stack those, we begin to get somewhat extended trends. Now, if we understand, we're talking about market structure, we're talking about patterns on charts. If we understand that this is the pattern of a trend, then we can start to see how might a trend end. And if you look here on the left, you see we have a market that is going to new highs and then pulls back, and then look what happens. It fails to make a new high. This is one way that a market can show us that a trend is breaking down. We just failed to make a new trend high and flip everything upside down here to look at downtrends. On the other hand, on the right side of the screen is another pattern. Look what happens here. It's subtle, but it's different. And this, by the way, relates to current action in the S&P 500. If you're listening to this archive down the road, we're in the middle of October 2018. And in this case, what we've seen is this pullback is deeper than the previous upswing. So we end up making a new low. That's the difference with these two patterns. You can have a market that fails to make a new high, or you can have a market that makes a new low. Now, we don't really know, of course, what's going to spin out here on the right. I'm showing you an idealized example where the market then very politely rolls over into a downturn. It happens, but it's also possible that we can get faked out both ways. The market can continue higher. That's the uncertainty. So what I've just shown you is a way looking at price structures to compare each swing to the previous swing. And you're looking in both price and time. Longer swings are stronger. And it makes sense, right? If a market's able to go up 8 points versus 10 points on a previous swing, well, those 8 points, it's not as far. The market is losing some strength. This is very interesting because it seems extremely simple, and it is, but this is a price-based approach that when you learn to integrate it into your reading of markets, you'll find you're often ahead of indicators. You'll be ahead of indicators, you'll be ahead of many algorithms, you'll be ahead of many systematic approaches. You'll also be wrong sometimes. I have to keep coming back to that. That's the probability aspect, but you will be on the cutting edge of market dynamics when the trend is shifting. Last thought here, I've also come to believe over the years that there's not a lot of value in measuring things with extreme precision if you're looking at price action, because there is a healthy degree of noise and randomness in the market. Close enough, or almost, in this type of discipline really is enough. I'm going to skip over this a little bit because I'm just reinforcing some things that I said here. But if you define the swings, and the swings mean the movement up and down, and then you look at the swings with these guidelines, that if you're in an upswing, if you're in an uptrend, your upswings will be larger than your downswings, both in price and time. And in a downtrend, the reverse is true. You want to see when the pattern changes, when the pattern breaks down, and that's really critical. That's perhaps the most important thing, that you want to know when something is really changing in the market. And do be aware when a market is in balance. Another recent example of that is natural gas. Not now, but if you go back for many months, starting a few weeks ago, and then you go back through the summer and spring, natural gas was a market that was very much in equilibrium, and we just kind of bounced around in a little trading range. And those markets don't usually give us clear patterns. They give us patterns when they break out of those areas. Just to reinforce what I said graphically, here is an example where we are comparing only in magnitude. So I'm looking at this swing here, only in magnitude, that this upswing is bigger than the downswing. And this will give us, this is just a visual illustration of that principle. Here's another way to show that we can compare the length of these swings, which I have colored here. And you can see this is a market that may be losing some momentum because the swings are lower magnitude, shorter magnitude as it goes on. And then here is an example of a market completely breaking down and a complete break of trend pattern. Now, somebody, Nate, actually just typed into the question box that uptrends are made of higher highs and higher lows. Yes, this is true. But what we're looking at here is actually the mechanics behind that. That idea of an uptrend holding both a higher high and a higher low is one of the critical understandings, one of the first things I teach people when evaluating price charts, but you can't really trade on that information. You get faked out enough that the actual utility of it as a standalone system is questionable, but if you understand the dynamics that go behind it, it starts to make a lot of sense. I have some price charts here, but we've been talking about price charts. I'm going to skip over them and just summarize the market structure approach with saying this is really mostly about length of swing. And momentum matters. Momentum is a relationship of the price movement over the length of time it takes to make the movement. And this is why some people kind of get caught up, I think, in angles on charts. We know, you might have believed angles back when you were looking at a chart in a newspaper, but now it's so easy to change an angle by changing scaling. But this relationship that you can see if you're looking in context with previous swings, the relative velocity over time of swings, which is just, I'm using different words, but just what I've said to lead us to that price structure, and most importantly, to where something changes. Last thought here on price structure. I've shown you really idealized, really simplified patterns, but this is useful. I think if you took that knowledge and ran out to the market and tried to apply it, you probably would find it's very difficult to apply it as we've discussed. But what I've shown you is what is underneath all of my reading of markets. And anytime I look at markets, this is what I'm seeing. This is what's there. Okay, let's switch gears just a little bit and talk about trend lines. It's not really much of switching gears because trend lines are so incredibly closely related to market structure. And in fact, trend lines used properly, and of course, what's properly? Well, everybody has their idea of properly, but look at this. The question with trend lines is which one is right. Like I work with, over the years, I worked with a lot of beginning traders, and sometimes in trading forums, sometimes I'll say something about a chart somebody's done, and people get very passionate, and they say, oh, I can draw any line I want on a chart. Well, of course you can, but what are you going to do when the line is touched again? And which line is going to be, maybe right isn't even the word to use, but which line is going to be the most useful? Which line is going to really tell you something about the trend? And frankly, I think a lot of these lines I've drawn on this chart are garbage. And how do we tell the garbage from the good ones? Well, be aware that any line you draw on a chart is going to look important to you. So that's one huge challenge. If you start to look at whether you're looking at levels or ratios or trend lines, just because the line's on the chart, your brain is going to process it into a pattern. So you need to think about what's the trend line supposed to tell us. And excuse me for a moment while I take a very unprofessional drink of water, but I am still fighting a cold that I got on an airplane. It's lovely. Okay, so what is a trend line supposed to do? It's supposed to show us the accepted rate of growth. I'm talking about uptrends here. If we were talking about downtrends, we would say a decline for a market. If we know what the market has accepted as okay, as normal, then we can monitor that trend for some change, for the trend getting faster or slower. I would suggest that these are guidelines that have served me very, very well over the years for trend lines. You might consider them too. Uptrend lines are upward sloping. That's kind of obvious, right? Uptrend lines are best drawn between pivot points. This will eliminate the lines that are drawn through the middle of price action. Some people do that. And yeah, you can, if you draw a line through the middle of price action, what you could argue you're doing is showing in a useful way, hey, the market's kind of moving in this direction. And there might be value in that, but I can't do anything with that line in the future. Do you see what I mean? If the market is chopped back and forth on both sides of the line, why do I care when the price touches the line again? So that's my problem with what people would call internal trend lines. And some people fit those with the regression analysis. You kind of get the same thing. I do think that the most important point you really want to capture is the pivot before the high of a trend. And by pivot, I mean swing low. People use pivots in different terminology. But I'll show you some charts. This will make sense in a minute. And then you want to go back as far as you can and still capture that penultimate pivot low before the trend extreme, and you don't want to cut prices. Now you'll have these slides. I realize that looking at this and listening to this, you're probably a little confused. Let's look at some examples. Okay, so here's a trend. Here's the trend extreme. So the pivot that I want to capture, and I've actually not drawn this line perfectly, is here. I want to capture this, and I want to go as far back in the trend as I can. And in this case, conveniently, I could go all the way back here. This, to my mind, is a valid trend line. Now, I say don't cut prices. It can cut prices after you draw the line. So the line was drawn here, and then it's broken. Here are some other examples of trend lines. All of these would have been valid at one point in time. So if you look here, the market is at a high. We'll capture this previous pivot low before the trend extreme and extend the trend line here. And this principle carries through for every one of these trend lines. The fact, and this also, by the way, makes a good illustration that just because a trend line is broken does not mean the trend is over. People tend to think that. It doesn't really work like that. Here's an example where you can see I'm drawing trend lines, and look, each trend line is steeper. Each trend line slopes more. This is a way to highlight. If you would see the same thing with a moving average, you might or you might not be able to see it just based on the price chart. I don't think it's crystal clear to my eye on the price chart, but this trend was accelerating to the downside, and the trend lines will highlight that. I'm not going to spend a lot of time on this chart. You can go through it when you look at the PDF, but every one of these were valid trend lines. So if you have a trend line, then you can do something else very interesting, which is to create a trend channel. And I'm going to skip over this slide and just show you the trend channel. What you do is you create a valid trend line. So here you would create this trend line on top, and then you copy it or clone it, and you drag it down so that it does not cut prices between the attachment points of the trend line. So in other words, this trend line was drawn between this point and this point. So I clone the line, I drag it down to the trend extreme here. I can't put it here, I can't put it here because it would cut through prices, so I have to go here. And the trend channel is, I don't know why it works, to be perfectly honest. I think it's related to growth rates and volatility. We could have some perhaps interesting, perhaps not discussions about that. But I will tell you from a practical perspective, on any time frame, when a market presses into that trend channel extreme, you want to pay attention. Maybe in this case, you see what I'm showing you here is that accelerating trend. Maybe in this case, it will continue to accelerate, but many times you'll see a market will back off from that point. It's at least a point to be aware of. It's as important to me as understanding that we're very overbought or very oversold on some indicator. I may not take action on it, but I want to know. And here is a still relevant long-term trend channel for the US stock market. And it's kind of interesting to see what's happening with this today. So what happens when the trend line's broken? I hinted at this before, but many, like we have this idea if you're drawing these uptrend lines, that if an uptrend line is broken, you should short. That's a very painful thing to do because trend integrity will usually win out. And what you need to see, a trend line being broken can be a good warning sign, but it also requires some confirmation. It'll require confirmation in terms of price action. You really want to see that, let's say you have an uptrend and it goes down and touches the trend line. You want to see that there's some momentum generated through that trend line. And this, you see where this takes us? This takes us back to the end of that price action section, the market structure section, rather, where you're looking at the momentum that happens when the trend breaks. You're looking for some evidence that something is different. What the trend line really gives us is a way to understand where we really need to pay attention. It's kind of the way I would think about it. Moving averages. So I won't spend a lot of time on moving averages. You all know what moving averages are. To define trend, they're commonly used in a few ways. You can look at the slope of a moving average. You can look at the relationship of a market to the average, that's maybe not written very well. What I mean there very simply is if you have a moving average, if we're above the moving average, we're in an uptrend. If we're below, we're in a downtrend. That's what bullet point 2 says, but I wrote that in a very confusing way, apologies. Questions of smoothing and confirmation arise. Like, for instance, if you are using this relationship of the market to the moving average, there are certainly going to be places where a market chops back and forth through the moving average a lot. And you may or may not want to accept those multiple whipsaws. So you might want to have some rule like you require a number of bars on one side of the moving average, or maybe you put some kind of small band around the moving average. But what you're always doing with something like that, whenever you're adding confirmation, you're delaying the signal, and there is a trade-off. Just so, some people will say, oh, I require confirmation to eliminate false signals. Yes, okay, great, you are eliminating false signals, but at what cost? There's always a cost with something like that. Another really good question is what average? And just to see here, I put a short and a long-term moving, short and intermediate term moving average. And if we were, for instance, looking at the slope of the moving average, which mathematically you need to think about how to define, by the way. If you're going to play with that, I'll tell you one possibility is to draw some regression lines through moving averages. The slope of those regression lines will be a little bit more stable than if you were, for instance, just look at the difference between the last two moving average points. If that if you don't do system development, and if that didn't make any sense, you can safely ignore that. But look, you would have examples here where we'd say the market is still in an uptrend based on the longer term moving average, and it's clearly in a downtrend based on the shorter term. And in this case, the shorter term was right, but of course, we'll have other examples, right? The intermediate term says we're down here. The short term says we're up. So you can see how that worked out. No matter what, again, there's a trade-off. If you use the shorter average, you're going to have earlier signals, you're going to have more signals, you're going to have more false signals. But I have also done, and I think this is something that is almost unique to my work. I'm not aware of other people who have done and published this kind of work, but I've done a lot of work, and you can find it on my blog. I'll tell you how to find it, looking at price action and statistical tendencies around moving averages. And what you find is there's not the edge that a lot of people would like us to believe. For instance, if you use, this is looking at the slope of a 50-period moving average. I'm showing you one test out of hundreds and hundreds and hundreds I did for my first book. I looked at many, many, many different types of averages, ways to define slope. This is just one. They all show quite similar results. So what we're looking at here is, just look at the equities with me for a moment. The bottom box here, we're looking at 1.4-ish million bars, and these are daily bars of stocks with a mean raw return of 2.3 basis points. And 50.1% of these bars closed up over the time period that I was looking at, time period and sample. Now, go up to the top box. So this is, and by the way, 2.3 basis points is very, very close to zero. Let's just assume it's zero. If the moving average is sloping down, the mean excess return is a whopping 177 basis points. Positive. That's really bad if you're filtering your trades based on, so you're only taking shorts when the moving average is sloping down. You have started with a tremendous headwind. And of course, the same thing is, the same bad thing is true if you're only buying when the moving average is sloping up. You have an extremely negative return. That's not good. And people who are telling you just to trade with the slope of a moving average are perhaps not aware of this. It's also interesting, by the way, that if you look at futures, you see the sign flips. And you'll have the PDFs. You can look at this data. It's also on my blog. So you might actually get away with using a slope of a moving average for futures as a trend filter. It would not appear to work so well with stocks. And here's another very common thing. People will use, say, triple moving averages. So you have a short, intermediate, and long-term moving average, and you only take long trades when those moving averages are in, quote, the right order, meaning the fast is above the intermediate is above the slow. And the same for the shorts. You only take shorts when they're in the reverse order. And I won't make this a mystery. You'll see this also works. This is dismal on stocks. Actually performs quite well on futures. So this also, not to get too sidetracked here, but this calls into question this idea that we can use any technical tool on any market. And the reason I believe is because there are very basic differences in the balance of mean reversion between stocks, currencies, and futures. That's another topic. So the reason that these slopes and trend indicators don't work so well, at least in stocks, is lag and mean reversion in stocks. Stocks mean revert quite strongly. Trend indicators can only identify when the trend has turned, because you're only analyzing past data. Of course, you can't analyze future data. And just the way that stocks work, when this happens in stocks, we're usually due for a reversal. So you end up with reliability on the wrong side of the market. I just showed you, as I said, 2 tests out of hundreds. And I'll tell you, shortening or changing the indicator length really doesn't solve this problem. It's a very basic problem with stocks. Here's another technical tool that's used a lot of times, ADX. Again, I won't really make this a mystery. The problem with ADX is lag. There was a time in my trading career when I used it, and I realized that it was really tremendously lagging by, I was trading short term at that time, but I would be hours behind my subjective analysis when the ADX would allow me to take a trade. Some people use ADX based on a level. Some people will look on a trend. I just have not found. And you can see here the way the indicator works is when a market is strongly trending. This is our first chart we saw at the beginning, right? The ADX does go, in this case, I've given 20 as a cutoff, and does trend up. And the ADX also will, while the market is in a range here on the left side of the screen, the ADX will fall to the downside. Yes, this is true, but again, there's a tremendous amount of lag in this indicator, and it doesn't really do what it's supposed to do. I also developed basically thinking around. It's funny when you're doing quantitative work, you reinvent the wheel a lot, and I basically reinvented stochastics, and this is another way to look at trends, which just looks at where we are in a previous range, basically. And if you're at the low of a range, you can say market is trending. If you're at the high of a range, and you're using a moving range. But again, this tool, this is a tool that I do use in some of my quantitative screening, but it still lags, it still false signals, and there is absolutely no 100% reliable tool for finding trend changes. I do also think that there's a lot of value. So I've just ripped up moving averages, and if you read more of my work, you'll find that I'm more critical of ideas like buying crossings, or I'm sorry, trading crossings or trading touches of moving averages. But I do think there's value in a moving average to show us, first of all, what is an average price? What is the price that the market over some time window is accepted as average? And if you understand that markets are moving in waves of with trend and counter trend forces, then the bands can show you spots where something is changing or where a market is reaching an extreme. And there are probably three types of bands you should consider. Bollinger Bands are classic, and Bollinger Bands are certainly very well understood, and a lot of people have written and used those. Keltner channels, and when people say Keltner channels, really we're using something that's more like a Stark channel, which I think is the Stoller true average range channel or something like that. But it's the idea where Bollinger Bands look at price, the standard deviation of the price deviation from the average. But what you will look at with Keltner channels is a number of average true ranges from an average. And then there's also the possibility of just putting a number, some fixed percentage above and below a moving average. So in other words, you might have a 5% plus and minus moving average channel. I would prefer the first two because they respond to the market volatility, but I do think that somebody could find a utility for the non-adaptive channels. And you can just see here that this is very typical action around many kinds of channels. You will see when a market is ranging, it tends to sit within the channel. And when a market trends, it usually, and depending on how you calibrate your channels, but will press outside the channels and then come back in. And I'm showing you a very high level concept, but this is one of the most important things I know about reading market strength and trend integrity. That if you understand this alternation and the way that these markets move to extremes and then correct themselves through price and time, that's going to give you a pretty good understanding of price action and trend integrity. And it's also worth mentioning, and I would like you, I don't think I have a chart here, but you can do it after I talk about this, after the presentation. Please go look at a daily chart of the Dow Jones Industrial Average from late last year and early this year. And you will see an example of something that I call a slide along the bands trend. This shows up with the Keltner channels that I use, which are 2.25 average true ranges above and below a 20-period exponential moving average. And as I said, that's not truly a Keltner channel, but that's what many people use. When a market goes to a band and sits on the band, there is a chance, it's a little bit difficult to quantify, but it's a pattern that we can see many times in real time, and we talk about this a lot in the analysis I do in real time. It's a low volatility grinding trend that can go much further than anybody expects. I'm just showing you some examples here. It's difficult to trade because when it ends, and this is why I ask you to go look at the Dow Jones, when it ends in really dramatic fashion. And what you see with this slide along the bands trend is a breakdown of that normal alternation. I'm going to go back to the previous slide. Rather than the market making waves up and down, like I said at the beginning of this presentation, it just grinds down, 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 and presses. And many of these normal swings that we see are absent in this kind of price action. And this absence of those fluctuations is also a pattern in itself. It suggests a one-sided market. And of course, the danger of that one-sided market is, imagine you have a market where, or imagine you have a stock with high short interest. Let's just say everybody in the world that wants to short has already shorted a stock. What can happen? Well, if everybody's already shorted, it can't go much lower. So, and all it takes is a little bit of buying pressure in many cases to make the stock explode. This is an example from stocks, but happens with every market. And the slide along the bands trend gives us a technical setup for that type of action. More formal trend ending patterns. I'm not going to spend a whole heck of a lot of time here because I've written about these in many, many cases, but trends do end with, I really think, three characteristic patterns. They end with exhaust, which in the common language of technical analysis, people will talk about parabolic exhaust or hyperbolic exhaust. Sometimes people will say, people also talk about climax movements. I'll show you a chart in a moment. Trends can also just end with rollover. We'll talk about that in a moment too. Or with strong surprise momentum against, and surprise is in quotes, because it's not really always a surprise. And again, going back to the Dow Jones in February of this year, all US stocks in February of this year, was I able, in all intellectual honesty, to predict that collapse? Absolutely not. Was it a surprise? Well, I mean, it was a surprise from the fact that, we didn't know what was happening today, but it was not a surprise from the standpoint that we knew, given the market structure, given that slide along the bands trend, given the overextended nature of the market, this is a vulnerable market. And it's a market where a little bit of selling could lead to a lot of selling. So in that sense, you know that the, use what metaphor you want, but just basically that things are set up so that a little bit of selling could lead to a significant collapse. And sometimes it comes out of the blue. You certainly can think of it as, let's use an information example. If you're trading a stock and it reported earnings a month and a half ago, and the earnings were good, and the stock behaved well after the earnings, it's been in a long-term uptrend, and you might think you're going to hold that stock forever, and then some very bad news comes out about the stock, it can collapse in a day with absolutely no warning whatsoever. And sometimes the catalyst is very obvious. Sometimes it's not. Sometimes we don't know what moves the market, but sometimes it is a complete surprise. Apologize for my coughing. So here's a chart example, and some of these are old, but these are really very relevant. This is one of the best examples I've ever seen of climax. And this allowed us years and years and years ago to find a significant long-term top in precious metals. And it was kind of the same thing here. Here's this slide along the bands trend. This is what we would look at as a buying climax. You can see, we haven't really talked a lot about statistics around the channels, but it is quite unusual. Happens, but it's quite unusual for bars to be completely outside the channel. I call those free bars. And those are something that we look at and count and analyze. And we actually run a stock screen for these daily, where we look for stocks that have a lot of free bars. But it certainly does point to a condition where the rubber band is stretched. And then what happens? Well, it doesn't really take much to end up with a complete collapse. And in this case, you can see that this market did what emotional markets often do, which it then overshot to the downside. So you had your extension here to the upside, you had your collapse to the downside, you have a little bit of an exhaustion on both sides. And in this case, longer term market structure turned out to give us a pretty good edge. Here is another short-term climax. This is just markets overreact, markets overshoot, and candles with long lower shadows. Some people call them wicks, but if you see a candle that probes to some price, ideally on a larger than average range, and then snaps back, that is also many times an example of a market that has made a temporary extreme. And people do trade off of those. There are people who focus heavily on those. But one thing that you want to think about, this is a great slide coming next, one thing you want to think about is your expectations following those extremes. I believe the first mark here was the previous chart. And you can see there are multiple cases where the market overshot. And if you had been calling a stock bottom on every oversold level, based on whatever indicator you want to use, whatever bands you want to use, even on price structure, if you'd been calling constant bottoms through 2008, you would have, eventually you get it right, but you have to be prepared to be wrong a lot. Now, can you trade like that with good risk management? Perhaps there are people that do that. Rollover. So it's interesting because the very simple schematic that I threw up at the beginning of this presentation that I said was so important, that probably seemed kind of boring because we were just looking at kind of theoretical swings, right? This structure is actually what is behind every classical chart pattern. And I have a very extensive trading course, which I'll tell you, it's completely free. I'm not selling you a trading course. I'll tell you how to go find it, how to check it out. It's on MarketLifeTrading.com. It's about 30 hours of video. It's been up for years and years. Over 10,000 traders have been through part of the course, and many have completed it. And it's just, I don't want to sell the course too hard, but you should go do it. Just trust me, if you haven't done it, it really could change the way you look at markets. And I do have a section there on classical charting. I look at the original Edwards and McGee material, and it's very interesting that when you understand how to read swings, when you understand how to read momentum, and when you understand how to read market structure, you don't need all of those patterns. And all of the scalloping tops, double tops, triple tops, rounding tops, head and shoulder patterns. I haven't looked at a head and shoulders pattern except to discuss head and shoulders patterns academically. I haven't looked at a head and shoulders pattern since 2002. It's just not something that is in my lexicon. It's not in my vocabulary for thinking about markets, because I think of markets in terms of swing structure. I think of markets in terms of understanding the dynamics that fit behind those. And rollover is just simply where a market is unable to continue pressing to a trend high. And you'll see things like momentum divergences, but you also see it very, very clearly in price structure. And here is a chart of a kind of nasty surprise momentum against. This might have been a market. If you had been trading this, you might reasonably have been looking to buy here based on the pullback in a long established trend. And then you might have, if you were long, you would have had a nasty surprise. That's part of trading. But this also shows us, if you're looking to buy here, once you have the strong downside momentum, the market is no longer well set up for a long. So that goes back to those three patterns. If you understand from a high level perspective, all of the patterns that people look at with ends of trends will fit into those patterns. Practical trading guidelines. We hear all the time, the trend is your friend. maybe it's true, but you do need to decide what kind of trader you're going to be. Are you going to be a trend trader? And if you're going to be a trend trader, you're going to be like a classical trend follower, or you're just going to you look to take pieces out of a trend, which I would think of more as a swing trader. The difference to me is as a swing trader, which is the style that resonates with me, and it's what I've focused on almost exclusively since 2008, at least. Swing trading is where you're really trying to just take an easy, I hope you hear the air quotes, an easy chunk out of a trend. You're not really looking to sit through a lot of give back. You're not really looking to sit through a lot of volatility. That's different than a trend trader who may be prepared, is looking to ride a huge trend, but you also, if you're going to do that, you have to be willing to give back a lot and to ride that huge trend back down potentially. A range trader, so you're looking to trade, in fact, when there is no trend. So, we would throw out that the trend is your friend, but if you're a range trader, the trend is your enemy. And in fact, you will lose as a range trader when the market trends and rolls over you. Also, if you're selling a lot of option premium, well, if you know a market's going to trend, you can adjust your trades appropriately. But ideally, if you're selling a lot of option premium, you want a market that's not really going to trend. So don't assume, like we all do at the beginning, at least I certainly did, that, oh, I see these great trends on price charts, I want to capture all these trends. That might not be the way you end up trading. And you need to have a very clear plan. And I know some of you are probably tuning out a little bit here, but what I'm going to show you here, what I'm talking about here, this really is the difference between success and failure. And I've seen this over and over and over again, that traders who trade, who work without a plan, don't have long-term success. You may have some great trades, you may learn a lot about markets, but you're probably not going to trade as a career unless you have a clear trading plan. And you're not going to be a disciplined trader without that plan. You can't be. Discipline, then that's another topic we can talk about in a future webinar, Cynthia. But discipline is something that people focus on a lot. But discipline really is the result of everything in your trading universe being right. It's something that, yes, we should work toward, but it comes from having everything else right. If you have a plan with an edge, if you have a structure to evaluate your behavior, only when all of these things are there, only then can you be a disciplined trader and focus on that job number one, which is to follow your plan. Got to have the plan to follow it. Summary, many ways to measure trends, none are perfect. I focused a lot on the imperfections here, but I think that's very, very important. Do be careful of combining different ways to measure, especially if there's overlap. If you are slapping 7 indicators on your charts and a bunch of trend lines, you're probably measuring the same thing with most of those indicators, and it's probably adding a lot of noise and not really adding a lot to your analysis. A lot of people discover that as they simplify, their trading gets a lot better. And that's something that I've seen over the years with my own work over and over and over again. Of course, you could oversimplify, but as many degrees of freedom as you can eliminate, the better your trading will be. Also, we haven't really talked about this that much, but you need to trust your intuition as a discretionary trader, but you need to train and structure that intuition. And as a beginning trader, you don't really know what you don't know, and you can't really have intuition. But as you work to build this, as you work to become a disciplined trader, listen to those flashes of inspiration and intuition you have. And I think that's a pretty good wrap up. Let me tell you where to find some more information, and Cynthia is going to tell you where to find some more information in a moment. You can find my blog, adamhgrimes.com. You also, by the way, can Google many technical analysis concepts with my name attached. If you want to know what I think about Fibonacci ratios or moving averages, Google Fibonacci Adam Grimes, and you'll find a bunch of articles that I've written on many, many topics. And if you have questions, I try to be pretty accessible. Maybe some of your questions will help me create some new cool stuff. I am in the process of actually recording another podcast episode that talks about today's topic, dealing with trend integrity and looking at it in terms of what's happening in the market right now and how you trade it. So do check out my podcast, which is called The Trader's Workshop. You can also find that from my blog. And I mentioned the free trading course. I have a couple books here which I would love to have you check out. And Cynthia, I'm going to hand off to you in just a moment. You can show them where to find my Market Life work on Traders Workstation. But I will say, while she is doing this, if you have questions, type them into the question box, and I will do my best to get to every single question. But Cynthia, I'll hand off to you for a moment.
Okay, well, great. Thank you so much, Adam. Terrific information. And by the way, if you do have questions, I'm going to turn this back over to Adam in a couple of minutes, so make sure you add those into the questions panel. Now, I do want to show you that Market Life Trading is available on the Interactive Broker platform. Now, you can access the information underneath our pricing menu. Notice here, there's research, news, and market data. From this window, you'll be able to access any of the subscription items that we do have available. Now notice I am going to, you'll see when we get to this page that our research items are included at the top of the page. This also will give you access to the fees that are charged for any of our subscriptions. Notice we do have separate billing or trader status, whether you're a non-professional or a professional, and you can find the cost for each of those will be included on this window. Now, I am going to jump down to the Market Life. By the way, you can find Market Life, and there's two different versions that are available. Now, when you do get to this page, notice here you can view a sample report that Adam has put out there, and even access the website. I'm going to open up that sample PDF report, and you'll see that you can access this information for or with that Market Life subscription. Now, speaking of Market Life subscription, once you do subscribe, by the way, do want to let you know there is a 30-day free trial period. So if you do have an interest, you can sign up for that free trial through your account management system. Access to account management can be made through the Interactive Broker platform, simply going up to the account menu, and notice using this link here will give you access to account management without having to log into it separately. So now with all of that, once you do subscribe, you'll get access to these reports available through the Interactive Broker platform. I happen to be on the Mosaic interface, but for classic TWS users, you can find the same information under our analytical tools. But if you do go through our new window drop-down button, notice at the very bottom of this page, you'll find Analyst Research, and here is where you can find or access Market Life Plus as well as Market Life Premium. There are two different subscriptions that are available. So I wanted to point that out, where you can find that information directly within our trading platform. So with that, I think we've given Adam enough time to read through some of these questions. So I'm going to send this back over to you, Adam. If you could share your screen, that way we'll be able to catch up with any of the information from your slides. And by the way, before I do turn this back to Adam, both the slides and the recording for today's event will be available from the Interactive Brokers website. Underneath the education menu, there's a webinars link, and it will appear under our industry-sponsored events. But you can always find Adam's selections or any of Adam's webinars by simply adding him in the search field as the presenter, and you'll find any additional items will be available. So now I'm going to send it back over to you for those questions. Thanks, Adam.
Fantastic. Thank you very much. Okay, so I do have some good questions here, and if you have more, go ahead and dump them in the box, and I'll do my best. Somebody asked about Twitter handle, and I use Twitter as kind of a central hub. If I publish a podcast or write a blog, you'll find it on Twitter. So my Twitter handle is @AdamHGrimes. That's kind of my social media brand for everything, Adam H. Grimes. You can find me there @AdamHGrimes. Okay, so let's dig in. Carl asks, is this the top on stocks? And he's probably, thank you, Carl, he's probably a long-term reader of my work because he notes that I've been bullish for many, many years. And that is one of the things that's distinguished my work over the past few years. A lot of technical analysts have been calling for a crash and have been bearish at different times. And there have been a few spots where we've raised some warnings in my work, but we've certainly maintained the bullish context. And I do think the short answer is yes, maybe that's changing. I am significantly less bullish than I was in late summer. And the reason is, and again, this podcast that I'm going to do today will talk about this a little bit more, but I think we're beginning to see some breakdown in trend integrity. We're beginning to see some things that remind me of some echoes of some early 2007 action. Now, I don't necessarily think we are headed for an immediate downturn, but if you're using these tools that I just gave you, and if you're applying these to the stock market, what you find is that we certainly are moving more into a period of uncertainty. Yeah, at least we're moving into a period of uncertainty, and we're starting to see the kinds of shocks which historically have led to a breakdown in the long-term bull market. So is this the top? I don't know. Nobody knows. Anybody who tells you they know is lying to you or lying to themselves. But I do think for the first time in many, many years, we're starting to see some significant danger to the bull market. And last word on that, the big sell-off we saw last week on a volatility adjusted basis was one of the 4 or 5 biggest days ever in the S&P. We have to go back to the 1987 and the 1989 aftermath of the 1987 crash to find parallels, or there's another parallel in early 2007. Food for thought. Okay, so somebody asked, how reliable are MACD divergences? The problem with divergences, and I used divergences for most of the first 10 years of my trading career, and the problem with divergences is they work sometimes, but it's very hard to quantify. And what you will really, and I'm going to suggest that one way you can do this is you need to collect many trades that you personally have used divergence on and many trades that you have passed on. I think this is, I'm speaking from the standpoint of a discretionary trader. Yes, you can code divergences. That also is a little bit thorny, but it can be done. But if you use them in a discretionary context, it was not until I was able to go through about 400 or 500 trades very carefully that I saw divergences were not adding to my work. They were keeping me out of good trades, and they were not giving me any higher reliability, basically, of a trend ending signal. Now, having said that, I will sometimes call attention to a divergence from an analytical perspective if I think it's glaring. If I think there's something else glaring that people should see, I might say, oh, and we also have a MACD divergence. But I have not traded on a MACD divergence since 2006. So no, it's not something that I use in my work. It's not something I found a lot of value in. Somebody says, does it matter what time frame of charts you use, 5 minutes daily, etc.? So every market, every time frame has a little bit of a different character. And I think that, yes, the big concepts certainly apply, but you would find it quite difficult, I think. Let's say you're a very good trader on the 5 minute chart, okay? And then you want to go trade daily charts just like that. You're gonna have a really rough time. And the reason you're going to have a rough time is partially psychological, because the difference between how you think about and manage risk on a short and long time frame is quite different. But it's also analytical, because the way that very short-term charts move, and you can, if you analyze it, you can see some differences. It goes back to momentum and mean reversion. For instance, if you trade off those very short-term charts, you might look at the high and low of the day. Well, if you're trading on a weekly chart, the high and low of the month doesn't have the same significance. And so you'll lose some tools. However, having said that, it does not, you can certainly apply these concepts to any time frame. I will say anecdotally, and this is, let me vigorously put a disclaimer here, as this is my personal experience, but I have seen it over and over and over. Traders generally do better when they gravitate to the longer time frames. So one of the things that I've seen turn a lot of people's trading around, if you're struggling on the short time frame, maybe try lengthening your time frame a little bit and just see what happens. Robert asked, what's my opinion on the 200-day moving average as it relates to the markets? Google Adam Grimes 200-day moving average. I published some work on it. There's this idea, right, that the 200-day, the 100-day, and the 50-day are maybe kind of special. And people will tell you with great authority, well, hedge funds buy at the 200-day moving average. I would suggest to you that people telling you that with authority don't really know that that's true, and I have not seen any evidence that it's true. What evidence? What evidence? What do I mean? Well, I would assume that if, let's say, big funds buy at the 200-day moving average, as people tell us, I would assume then that if I look at price action around the 200-day moving average, and I compare it to, let's say, the 190, 180, 220, whatever, I'm just other periods of moving averages, these special moving averages should somehow look different, and they do not. They do not quantitatively, and you will not find anybody who preaches about the importance of these moving averages backing it up with a quantitative study. It's, it's kind of pointless in a sense to do a quantitative study and to say we found no edge. Not finding an edge you can't prove the thing doesn't work, but you can at least prove there is no clear edge. And from a quantitative perspective, I can't find the slightest shred of evidence that there are any special moving averages. And maybe I've missed something, maybe there's another way to look at it. I am aware that there is a difference in equity and stock market volatility above and below the 200-period moving average, but the 200-period moving average is not a line in the sand. It's the general concept that if stocks have declined a lot, and this is what it would take to get under the 200-day moving average, stocks tend to be more volatile. Also, the really crappy things that happen to stock markets generally happen after stocks have declined a little bit, so this automatically puts us under some of these averages. That's my experience, that's my testing. 200-period moving average is not something that I look at in my work, but I think if you understood it correctly, you understood what you're trying to do with it, maybe you could find some utility. But Google 200-day moving average in my name, you'll find some writing on that. Somebody says, I don't, Christopher says, hey Adam, you mentioned you don't think classical trend following works very well anymore. Problem is the pyramiding the original turtles used. But apart from pyramiding, even if you leave out the scale and entry, why, in your opinion, is the traditional breakout style, no target trend following doesn't work? Christopher, I'm not, I think maybe you're teasing two things, maybe we tease this apart a little bit. So pyramiding is a problem for many traders. And for those of you who don't know, pyramiding, by the way, is how I thought I was going to make my fortune when I started trading. I was going to start trading with a very small account and catch the beginning of a trend and buy one contract. And then when I had profits, I was going to buy two contracts, and then I was going to buy four. And then eventually I was going to corner the whole market. Well, that doesn't work. Why? It doesn't work because of what it will do, the volatility of your equity line, of your equity curve, and it also doesn't work because you can't handle that psychologically. If you start out as a one contract trader, let's say this would work for you. You start out as a one contract trader, let's just make up a number, your daily P&L swing is $300. Well, what's going to happen if you do successfully pyramid and your daily P&L swings are $30 million? Can you handle that? No one can, of course not. But disciplined pyramiding is a part of many successful trading strategies. I think the problem with classical trend following is, I think there are two. First of all, the people who advocate this for individual traders, I think it's problematic because the drawdowns are challenging, let's say. Drawdowns on order 50 or 60% lasting several years. It's really hard to convince me that the average individual trader, well, let's not even say average, that's appropriate for an individual trader. The other problem is that I think there's quantitative evidence that markets aren't trending in the same way anymore. That perhaps, now, so then the question is this a linear or a cyclical thing? So did we see a trending environment in the 70s and 80s that we will never see again? and certainly there are many examples of people who put a few $1,000s into the market in the 1980s and made many millions of dollars. You do not see those examples from the 1990s or the 2000s because we don't see these kinds of big extended trends. Will we have these kinds of trends at some point in the future? Trend followers say yes. I say I don't know, and I'm not really comfortable with 60% drawdowns to find out. Last piece of evidence on that, if you look at trend following indexes, so these are indexes of professional trend following funds, just go look at some of those and see if recent performance, recent being last 10 years, is something you want to bring into your universe. Next question. Somebody asked about ATR, ADR. I think you're talking about trend measures. Yeah, I don't find that a useful trend measure, but it's important. It's one way to measure volatility, ATR. Somebody says in a slow-moving stock like utility, if ADX signals trend reversal, run for cover. You're making the assumption that a slow-moving stock is always going to be a slow-moving stock, and utilities are not always that slow. Also, they're better signals. Yeah, if you're waiting for an ADX reversal on a daily chart, you'll be out months before with other tools. And of course, with the trade-off. Somebody asked about the relationship between price and volume. I don't use volume much in my work because volume is so tightly correlated with the range of the bar that it would basically be double counting. So I don't. There are some specific cases where volume might be useful, but I don't find volume to. And I know this makes me a heretic because one of the core beliefs of traditional technical analysis is that volume is the most important thing, and I do not find that to be true at all. Also, by the way, other people who do quantitative work will tell you the same thing. People who write volume books will tell you the opposite. Islam asks, what's my name? Adam Grimes, and you find me on Twitter at adamhgrimes.com. I also do want to just kind of reinforce what Cynthia was showing you. I am very, very proud of what we're doing with Market Life. I have a partner, Tom, who has helped me greatly in shaping and creating this and in the daily operations. And I've been creating research for people for 10 years. And what we have here is something I'm really very, very proud of. And we do have a free trial, so please check it out, see if it's something that can make a difference for you. I'm just skipping over some, and I see many, many nice things here, and I will just say thank you, kind of en masse for those. Thank you for the compliments. Vikas says he made profits on 17 out of 20 days, but gave it all back in 3 days, and he's very bad at keeping discipline. And he asked for any tips. Yeah, do you have a written trading plan? And then you need to make sure your entire life as a trader is all about following the trading plan. And you might even create painful rules for yourself, like if you break discipline, you're done for a week or something like that. I respond well to that kind of sort of tough love, really hard edge. Other people don't, but that worked for me. Everybody has these problems. I had these problems. I would trade very well for weeks and weeks and weeks, and then blow up the whole month in a single day of stupidity when I was a short-term trader. And you can't do that. You have to tell yourself if you're going to do that, you can't be a trader. So you got to get out of it. You might also, by the way, try longer time frames is something to consider. Benefit in trading a different variety of asset classes. Wouldn't it be more efficient to learn one asset class and trade that consistently? Eugene asked that. Yeah, Eugene, I think, I'll tell you personally, every time I went to a different asset class, it was a disaster. When I was successful with something and then moved to something else, I had a significant relearning curve. But I do find that, for instance, if you're trading stocks and futures, you'll find that the performance will offset many times in a very constructive way. It can smooth out your overall equity curve. You don't need to do it. There are specialists who trade just one stock. There are specialists who trade just one futures market. But personally, and it's kind of become, as my perspective has grown, I have found it to be very important for me personally to have a pretty good sense of what's going on in every asset class, but it is not at all essential. Alexander says on the S&P 500, we lost the last bottom. We're above the 200-day moving average and now in a lateral pattern for 3 days. He's asking if this is going to transition to a bear market. You know, Alexander, the questions you're asking here are the same questions I ask myself every day, and I don't know. But what I can do is quantify the probabilities. And I will tell you the podcast that I hope to get done today, I'm going to talk a lot more about that, and I will answer that question specifically there. Eddie asked about volume, a critical component to price action. Let me just say no. David says, do I use breadth indicators? And if so, which ones have I found most useful? David, the problem with breadth is that on one hand, it's a little bit like an ink blot test. You know, you can always see whatever you want in it, but there's also this consensus thing, right? Like where I get really worried is when everybody agrees with me. If I come out and say, you know, I really think stocks are going up, and everybody else in the world says stocks are going up, I'm gonna go home and think real hard about that. I'm probably wrong. And if you think about it, isn't that what breadth really does? I don't think enough people talk about that. And for those of you who don't know, most of you do, but breadth just means that what if we have a stock index that's making a high, but then we find that a lot of, that can happen in 2 ways. It can be a market led by a few big stocks, or the mass of stocks can be pressing to highs. And in the second example, where like kind of the whole market's moving to highs, people would say that has better breadth. I do use, in one of my tools, I use a volume adjusted breadth, but I don't use it as a primary tool in any way, and I can't find a really strong quantitative edge. So I don't think, if it's something you want to kind of play with and see if you can find any edge, there may be some incremental value, but let's just say this, I certainly don't think it's one of the most important things. Other questions on volume? Well, volume and price zone oscillators together. I don't know what a price zone oscillator is, but I don't use volume. Wow, another question. Okay, you guys like volume. Maybe we should do a presentation on volume. Nicolay says that being a heretic makes me a scientist. I guess you are right. Francis asked about the Stan Weinstein method. That's a good book, and I think what he has done is to, and then the title, I'm sorry, the title of the book escapes me, but it's a pretty good schematic, and it's a way to understand some of Wyckoff's context in a more practical format. I think that is a book that I absolutely would recommend that people read. And then Vika's asked my age. I'm in my mid 40s and how long I've been trading. Yeah, I started trading in 1995. I took a little bit of time off here and there, but basically been at it more or less since 1995. And that is the end of the questions. Again, check me out on Twitter at Adam H. Grimes. Check out my blog. And I would absolutely love for you to take a look at my Market Life work, which you can find on Interactive Brokers Traders Workstation. Thank you very much.
Well, Adam, thank you. And I want to reiterate some of the wonderful things I'm seeing in that questions panel. This has been a terrific presentation, and I want to thank you very much. I also want to thank everyone for attending here today and remind you that we've covered a lot of information, and I have been recording today's session, and each of you will get a direct link to today's recorded playback and the slides that Adam used in just about an hour or so. So do watch your inbox for those follow-ups. And with that, we are going to conclude our session here today. You can all exit using the X in the upper right-hand corner of the screen. Thanks, everyone. Have a great rest of your day.